5 months ago, Luckin Coffee was the darling of Wall Street. Its market value had once reached $12 billion at its peak.
But Starbucks haven't had a Chinese rival until now.
Luckin is leading with digital. They're going for your smartphone.
But today, it has dived over 90% as the company faces a delisting hearing that will determine their future on Nasdaq. This is the story of an ambitious, high-flying startup that came crashing down as quickly as it had ascended. Luckin Coffee was founded in the coastal city of Xiamen in 2017. Its founder, Jenny KrAsia, had her mind turned to China's coffee chain market from her previous jobs when she always had to work overtime with the help of lots of caffeine intake. With an angel investment from her former boss, Charles Lu Zhengyao, the founder of car rental firm Car Inc. and ride-hailing startup UCars, she opened the first Luckin store in Beijing. Jenny Tian believed there was huge room to grow in China's coffee market. In 2018, Chinese people drank an average of 6 cups of coffee a year, compared to 388 for the US and 279 for Japan. But in recent years, the Chinese market has experienced a 15% year-on-year growth, nearly 8 times the rate for the global market. The expansion of Luckin Coffee was rapid. By the end of 2018, it already grew to 2,000 locations and covered all the big cities in China. In May of 2019, Luckin went public on Nasdaq. It took them less than 2 years to go from founding to an IPO, while it had taken their biggest competitor Starbucks almost 21 years to go public. Jenny Tian wanted to beat its US counterpart in China. By the end of 2019, Luckin had 4,910 locations, overtaking Starbucks to become the largest coffee chain in China by number of storefronts. So what made Luckin Coffee different from Starbucks? First, there's the price. A grande latte costs 32 RMB at Starbucks, while at Luckin, the price is 25 RMB without subsidies. The price difference comes down to the different strategies adopted by the two companies. For a cup of Starbucks coffee, rent and labor make up a high percentage of the cost. Starbucks placed emphasis on its in-store experience, rather than simply being a place to grab a quick coffee. Luckin, on the other hand, pursued a minimalist strategy centered on grab-and-go stores. Nearly 91.3% of its stores are essentially small kiosks with limited seating. This strategy also explained how Luckin was able to expand so quickly. Take Zhongguancun, a commercial area in Beijing, as an example. Within just a 15-minute walk, in an area of around a quarter of a square mile, there are 7 Luckin locations. Many locations are small and located in low-rent back corners. Here comes the second point, a digital-first and only strategy. In stark contrast to other chains, ordering a cup of coffee from Luckin requires installing their app or running their mini program. After making a purchase online, customers can choose to pick up the coffee at a nearby shop or have it delivered. To attract more users, Luckin offered heavy discounts to customers. First-time customers could get a free cup of coffee, and different types of coupons and discounts are offered year-round.
I remember since the end of last year or even earlier, it began a latte season, which means like every latte is like half priced, which is so cheap.
So after the discount, which comes almost every deal, I don't know why, I don't know how it works, but a large latte only costs less than 20 RMB. That's unimaginable in cities like Beijing.
It's not surprising that this was the marketing strategy that Luckin adopted. Heavy discounts have been widely used in the ride-hailing industry, an arena that Jenny Tian used to work in. The strategy has had mixed success. For example, Didi, China's leading ride-hailing platform, used the cash-burning strategy to successfully capture the market and secure its dominant position. While bike-sharing startup Ofo also applied the discount model, but ended up on the verge of bankruptcy. For Luckin, it was a matter of whether they had enough funds to sustain the model. In Q3 of 2019, Luckin booked $74.4 million in net losses, widening by 18% from Q3 of 2018. A major reason for the losses were increased sales and marketing expenses, which had reached $78 million. When talking about Luckin, Starbucks CEO Kelvin Johnson said he didn't believe heavy discounts are sustainable. But Luckin was more focused on capturing market share than immediately turning a profit. Though it faced massive losses, Luckin Coffee didn't slow down, but went ahead to diversify. In July 2019, Luckin launched a new brand called Xiaolu Tea, which featured 10 tea-based products. In January of 2020, it entered the unmanned retail market with the launch of vending machines that could serve coffee and other beverages. Like competitor Starbucks, they began to sell baked goods and snacks, in addition to a line of merchandise within its stores. Luckin had expanded at an astonishing rate, and the story seemed too good to be true. On January 31st, short-selling specialist Muddy Waters Research said it had received an anonymous report alleging Luckin was a fraud and that the company had been inflating sales. Luckin immediately denied the claim, but its shares took a hit in the next day of trading. The story then took a sharp turn when Luckin submitted a filing on April 2nd, announcing that its former COO Liu Jian was believed to have inflated revenues by $310.5 million. Following the firm's admission, the share price of Luckin dived 75%, and the company lost nearly $5 billion in market value. The fraud also raised the attention of China's top market regulators. In late April, China's Securities Regulatory Commission announced an investigation into the company. In May, Jenny Qian and COO Liu Jian were terminated as the probe deepened. Later, Nasdaq notified Luckin Coffee that it planned to delist its American depository shares from the market. In response, Luckin plans to request a hearing before a Nasdaq panel and now await the results. Most of Luckin's new projects have been put on pause since the company ran into troubles, but the coffee war in China continues to heat up. In April, Starbucks teamed up with Sequoia Capital China to invest in the retail technology sector, aiming to digitalize its services. And following in Luckin's footsteps, the US giant has also opened several grab-and-go stores in China. Meanwhile, Canadian coffee brand Tim Hortons has secured backing from Chinese internet giant Tencent. The investment will improve its digital capabilities and help accelerate its expansion in China. Additionally, much-hyped domestic tea brands HeyTea and Naixue's Tea both started selling coffee last year. The competition to grow enthusiasm for coffee in a traditionally tea-sipping nation is far from over. Who will come out on top? Or who will be the next to fall from grace in a cutthroat and relentless competition? If you liked this video, hit the like and subscribe buttons. If you're interested in learning more about China's tech scene, visit KrAsia.com using the link in the description below.